Good afternoon. Let's look at chapter 18, process costing. I already talked a little bit about process costing in chapter 17 with job costing. Not really that much difference between the two, except here, as opposed to having one work in process like you have with job costing, here you've got multiple work in processes. So keep that in mind as we look at this. So let me go ahead and share the homework here. I'll make that bigger. There we go. Who's least likely to use a process costing system? Well, an accounting firm, right? As opposed to soft drink bottler, petroleum, paper manufacturer, having worked with batteries and nuclear fuel and automobile seats, all of that is, even though you've got various types, those are continuous processes. Types of product costs are the same. I mean, what's the big three? Direct material, direct labor, and overhead. It's the same for both job order and process costing. New concept in this chapter is what's known as conversion cost. So all we're doing there is taking the big three and leaving out material, because the question is, what are your conversion costs at converting your raw material into a sellable product? Well, the answer is direct labor and overhead. Direct labor and overhead together are conversion costs. Separately, direct labor and overhead plus direct material is your product costs. And product costs are inventoriable. SG&A, selling administrative, all that marketing, that is what's called a period cost, which is expense in the period in which it is incurred. Number 4, here we have a question about units. You don't need costs. I don't know why they even put that there. I guess to confuse you. Started month with 300 units, started 1,400, so we got 1,700 units and had 140 in process at the end of the period. So 300 plus 14 is 1,700, minus 140 is what? 560. Now that's that same algorithm. Beginning inventory plus similar purchases, goods available minus ending inventory is your cost of goods sold. Very similar. Units. Here's a question about equivalent units. Now, equivalent units is a new concept here in this chapter. Probably what is most different about this chapter versus the previous one with job order. Job order, you don't have that issue of product left in your work in process. Here, if you can envision having a company that's got 10 different work in processes, product is being transferred from each work in process to the next work in process, right? One to another. The key is you don't start with zero inventory and end with zero inventory at the end of every period in your work in process. That's just not how it operates, right? You've got beginning inventory and ending inventory normally. And so the problem is, how do you assign costs that you incur during that period? How do you assign that to a partial unit? A unit that's still sitting there and looks like a full unit, but it's not. Well, that's what equivalent unit does. It's saying that if I've got 10,000 cell phones that I'm working on out in my plant, if I've got 10,000 cell phones that are being refurbished, remanufactured, or whatever, and all the materials there, all 10,000 cell phones are sitting there on tables or on the assembly line, but I've only put forth 75% of the labor and probably 75% of the overhead, since overhead is applied based on things like labor or machine hours. So in reality, I've got 75% of that 10,000 cell phones that are complete from an equivalent unit standpoint. So in essence, instead of having 10,000 physical units there, I got 7,500 units complete in regard to conversion cost. It's 100% complete from a material standpoint, but from a conversion cost standpoint, I've only got 7,500. And it's really theoretical in how we do that. So what's going on here? It says we got 210 units in process, started 14, so we had 1610 at the beginning, and 130 units in process at the end. So how many units transferred out? Well, it looks like 1,480 transferred out, right? 210 plus 1,400, 1,610 minus 130 is 1,480. So 1,480 have been transferred out, and they're 100% finished. You can't transfer out something that's not finished. So 1,480 equivalent units or full units have been processed out. But of that 130 units in process at the end of the period, they're 40% complete. So 40% of 130 is 52. So even though I've got 130 units sitting out there, if I visually walk through the plant and saw 130 units, from a costing standpoint, I really only have 52. So I add that 52 to the 1,480, so 1,532 are my equivalent units of production. You may have to think about that for a few minutes for you to understand it, but read the text and the PowerPoint if you're struggling on that. All right, then number 6, got a journal entry here. And what we've got is we're trying to make a journal entry for this material, labor, and overhead that's been added during the month. So we got 300, 210, that's 510, and 530, that's 1,040. So I got $1,040 that's been added to work in process. Some of it came out of raw material, some of it's wages payable, and some of it's overhead, right? So there's my journal entry. Out of these categories into work in process. And notice the manufacturing overhead credit, remember the right side of the T account where you're allocating? That's what you're doing there. You're allocating out. I'll put that old one up again. Remember that from last lecture? Wrong side. Everything's backwards. You're allocating out. That's why it's a credit. What's on the right side? Those are the actuals that are coming in, but when I allocate it out to work in process, it's coming out of here as a credit and going to a debit to work in process. I'm allocating based on that predetermined rate. And then over here, I'm accumulating my actuals. At the end of the year, I'm going to see what my balance is. Ideally, it would be 0, but it never is. You're going to have to make an adjustment to manufacturing overhead to zero it out with the corresponding entry going to cost of goods sold. All right, number 7. Another journal entry, that's an easy one. Out of Department 1 into Department 2, $750. Uses this production cost report to evaluate performance. Production cost report. All right, so that's the pre-lecture. Let's go ahead and look at the next one. Make sure I've shared that. All right, so there you're just selecting whether it's job order or process costing. I think you probably can figure that out on your own by now. So we'll go to number 2. It's a good exercise. So there's the big 3. If I get tired of me talking about the big 3, no, it's not Dale Earnhardt, Sr. Direct material, direct labor, and overhead. So direct labor and overhead is conversion cost. That's very common terminology in manufacturing. We use that at Exide, we use it at Lear. Conversion cost. What labor and overhead is required to turn your raw material into a sellable product? Very important. All right, here we've got, here's a cell phone question. 15,000 cell phones, 60% complete, meaning if I walked out into my factory and saw 15,000 cell phones being refurbished, right? In fact, I just bought a refurbished iPhone. So 15,000 cell phones, 60% complete, that's a theoretical costing technique. So that says I've got 60% of my labor and overhead has been put toward refurbishing these phones, but I still got 40% more before they're done. So in reality, I only have 9,000 equivalent units. And again, that's just an accounting term that we have to use to cost our product. What about these 26,000 cell phones, 40%, 10,400? All right, number 4. Here we got a filtration plant, artesian water, 150,000 gallons. Direct labor, there's my information. So there's my what? There's my water is my material, direct material. Direct labor is my wages, overhead is manufacturing, so there's my big 3. All right, direct labor divided plus overhead is conversion cost of 40,000. What's my filtration cost? Well, it's all this added together, which is all this together is $120,000, isn't it? Divided by 150,000 gallons, it's 80 cents. All right, very straightforward. 2 departments, filtration and bottling. But here we're just doing filtration. Number 5. All right, so this is introducing a new concept about how do we account for these units. This is going to make more sense when we get to the very last self-assessment. I think I've written that on here somewhere. The production cost report. This is only one part of the production cost report. Production cost report layout is 2 sections. Unit section and cost section. The unit section, we have to know what the units to account for and then account for the units. And then the second part is how much cost do we have? And we have to account for those costs by applying it to our inventory. So keep this layout in mind when we get to some of these exercises. This first exercise is very straightforward, very simple. It's just about units. This is 4 parts, even though it's 2 really, units and costs, but it's 4 sections. And how we account for this on our production cost report. But the very last exercise, the self-assessment for chapter 18, is a good one. It has all 4 of these. And a T account, I might add. All right. So here again, this company's purchasing artesian water, stores the water in tanks, runs it through 2 processes, filter it, and then bottle it. Conversion costs are added evenly throughout the process. Look what it says, water is added at the beginning of the process. Why does that matter? It's important because when you've got ending inventory, your ending inventory has 100% of the raw material. That's what's important. If the material is added at the end of the process, like take battery manufacturing. When we were making batteries, the last thing that you did was put labels on the battery. So you could have ending inventory where inventory is added at the end, like plaques and labels, stickers, and all that. But here with water, it's still sitting there in your filtration, waiting to be filtered. So it says that 120,000 liters were completed, liters were completed and transferred out of filtration. Right? There's completed and transferred out. That's always 100%. You can't transfer out a partial unit. All right, and it says that during February, the filtration process incurred the following costs in processing: 205,000 liters, 205,000, 120,000 processed. So that means I've got 85,000 in ending inventory, right? Yes. 100% material-wise as far as units, because the water is introduced at the beginning. And so then I take whatever the percentage is here. I don't see it. There it is. Well, they even tell you the 85,000 ending inventory. 80% of the way through filtration. So 80% of 85,000, I've actually got 68,000 liters, right? Not physically, but from a cost theoretical, 68,000 because of how much cost I've incurred. And then units accounted for. Units to account for, units accounted for. Well, I guess they left out the units to account for. Units to account for is 205,000. So this was like part 2. Number 6. Another one similar. 50,000 units to account for in October. They tell you part 1, this is part 2. Units accounted for. What was on here? The top part of that is units to account for. This is part 2, units accounted for. 50,000. So if I started with 15,000 and accounted for 50, I must have 35,000 ending inventory. All right. What's 45% complete? Materials added at the beginning. That's important. That's why that's 35,000 right here. And so then 45% of 35,000 is 15,750. Number 7. They want you to calculate the direct materials cost per equivalent unit. So they've got 65,000 equivalent units of materials. That's my denominator. My direct materials cost is 20,800. So 20,800 divided by 65,000 is 32 cents. And then my conversion costs are 23.5 divided by 47,000. They give you all these numbers. It's 50 cents. Number 8. Matching question. Direct labor plus manufacturing overhead is conversion costs. That's D. Prepared by the department for equivalent units production costs, assignment of costs. This will make more sense when you look at the self-assessment exercise. That's your conversion cost, production cost report. Equivalent units of production. This is a theoretical expression of partially completed units. Process costing system for manufacturing of similar products. Read the rest. Finally, number 9. All right, this is similar data for all of these. We've got what? Units to account for. Completed and transferred is 1,900 or 1,300 plus 900. So we got 2,200 units to account for. 1,300 processed out, 100%. 900 are still there. It tells us that materials are added at the beginning, so that's got to be the same. And 10% complete, so that's 90. This will make more sense when we look at that self-assessment. Next one says they're 90% complete. So there is 90% of 900 is 810. All right, nothing else changed. Then this one says materials are added at the end of the process. All right, so that's going to be what? That's going to be 0. Same thing here for physical units. 1,300 is going to be 0 because the materials haven't been added. And 10% complete, 10% of 900 is 90 for material, or excuse me, for conversion costs. And then finally, this is a tricky one. Materials are added at the halfway point. Well, where's halfway? 50%. Well, if you're 90% through the process, then 100% of the materials have been added, haven't they, at the midway point? That's sort of a tricky one. So that's why you see 900, the same as physical units. All the materials have been added because you're 90% through, and there's 90% of 900 for my conversion cost. All right. Let's look at practice set 2. I'm going fast because you can stop and look or whatever on your own time. Another journal entry, practice set 2. Production cost report shows 15,500 in total cost, of which 2,100 remains in the department. So how much was transferred out? 15,500 minus 21, that's 13,400. So out of mixing and into packaging, 13,004. Number 2, how might production cost reports assist management in making decisions about this product? All of the above. Find a way to lower costs. How much the product is costing to make. There's been an increase or decrease in direct material conversion cost. All about costing your product. You don't want to lose customers from charging too much or thinking you're having to charge more because you think your cost is higher. Neither do you want to undercost something and find out you're selling something at a loss or less profit than it should be. Pricing decisions. Of course, if the market is setting the price like it does with lead acid batteries, then the whole focus is on trying to lower your cost of production. All right, number 3. Here we're making some journal entries as well. What you have here is your direct materials, your direct labor and overhead added during May. So that means you need to make a journal entry based on that. So there we got 6750 coming out of raw material, be a credit. See it right there for 6750. Manufacturing overhead allocated. Again, allocated is what? A credit. So that's why you see a credit to manufacturing overhead. And then you've got labor. 1,300, there's my wages payable. But all that goes where? Into my work in process. We're putting it into inventory. It's going to sit there in inventory until it gets moved where? When it's finished, to finished goods. And when we sell it out of finished goods, off my balance sheet into my income statement as cost of goods sold. All right, so I think we're probably done with that chart, maybe. Assignment of cost. What you're looking for here, completed and transferred out, because you're transferring from one department to another, aren't you? $5,400. And this is coming out of my blending department. $5,400. Credit from blending to packaging, the next work in process. You may have 10 different work in processes, which a work in process is another word for a department or a cost center. And there's a T account. 0 beginning balance. I don't particularly like the fact that they did this because what it should show here is your debit that was up here, right there, 10,050. It's the total of this right here. And then there's the 5,400 journal entry we just made, transferred to packaging. And so that says my ending inventory for work in process in dollars is $46.50. And what is my cost per gallon? 5,400 divided by the units transferred out, $1.35. So see how this helps you in seeing what your costs are. Make smart business decisions. And a manager would want to know all of this for these reasons. Cost per gallon. You know, as much as we talk about managerial accounting, which is what this is, in costing, it is tied to your GAAP, general accepted accounting principles, financial, external statements. Because you got a balance sheet there that's got your inventory value, right? Cost of goods sold goes to your income statement. That income statement with cost of goods sold is just another format, but that is what most manufacturers will use and merchandisers will use for their external financial reporting. So managerial and financial are tied together. You know, people say, well, managerial, you don't have to use GAAP, but in essence, you do. When we get into this last module in chapter 19 on, we start talking about cost, volume, profit analysis. Now that truly is internal decision-making type stuff. But this is still, even though it's managerial accounting, it is related to external financial reporting. Number 4, purchase raw materials. Now we got a bunch of journal entries. These are kind of like 2010 questions. Purchase raw materials. So we debit inventory, credit payables. Then once we pay it, we debit payables, credit cash, right? Used materials in production. So 28,000 is coming out of raw material. Where is it going? Well, it says 28,000 in mixing, 12,000 in packaging, and $700 in indirect materials, whatever that is. Could be pallets, cardboard, stretch wrap. But it was purchased as raw material inventory. Usually, stuff like that doesn't get charged. In reality, a lot of that stuff gets charged expense when you buy it. You don't put it in inventory and then expense it like this. That's all right. Just learn it the Pearson way for purpose of the exam. Then we had payroll, right? So there's my total payroll, 13.5. Part of it goes to my direct labor, goes to mixing and packaging, right? Direct labor. Doesn't say that, but that's what that is, direct labor in both of these work in process. The indirect labor goes to manufacturing overhead. And these are actual costs, right? These are actual costs that are incurred. Direct labor. Direct labor. Indirect labor. Those are your quality assurance, your environmental, your maintenance and repair, your material handlers, your dock workers. That's manufacturing overhead. But these are debits that would have been expense when you were in 2010, right? But now we're costing our product. That's why we're putting direct labor up here and indirect labor and manufacturing overhead. See, we just changed, still a debit, we just changed the account title and changed it from expense to balance sheet, and in manufacturing overhead, that's sort of just it's hard to define that one as an account. It is just like a holding tank or a bucket that's going to be zeroed out at the end of the period. And then finally, it says here, $3,400 in machinery depreciation. Well, we got to make sure our book values are correct on our balance sheet. So we're going to put that to accumulated depreciation, right? The debit would be up here to depreciation expense if we were in 2010. But now we put that to an accumulation as a debit under manufacturing overhead. Just like we do for rent and utilities. Instead of expense, overhead, actuals. Because remember, those are being allocated out on the right side as a credit out of manufacturing overhead. All right. And then number 5, more journal entries. Completed in cutting, so went out of cutting into stamping, out of stamping into polishing, out of polishing into finished goods. You're just moving from one asset to another, all 3 of those entries. And then when we sell it, it goes out of finished goods inventory and into where? The income statement, cost of goods sold. So from the balance sheet, inventory, to cost of goods sold, income statement. It's off my balance sheet. It's no longer in one of my permanent accounts. 44,000. And then we sold it for what? 110,000. So there's my debit to AR and credit to sales. So 110 minus 44 is 60. So we have $66,000 in gross profit, gross margin. Remember that a few chapters ago. And so that's 66,000 minus my SG&A, which isn't given here. 66,000 minus SG&A, selling and administrative, selling general administrative gives me my net profit, net income. All right, one exercise left, and it's a long one, but it's a good one. Self-assessment. You won't believe this is the second time I've done this chapter. I used a different webcam that's supposed to be better the first time through. Webcam worked great, but there was no sound. So here I am, late on a Friday, doing it the second time. All right. Hopefully this one, the sound works. I think it does because I had to do another video for somebody. And all right, so this is what I've been talking about for the last 30 minutes or so, about units to account for, units accounted for, costs to account for, costs accounted for. So this is a good self-assessment to see if you understand what's going on in this chapter in equivalent units. So here again, looking at the way this is laid out, you can see there units, and you see it there, units to account for, and then units accounted for. All right, and then it goes to cost to account for and cost accounted for. So that's part one. Hope you can still see that. So what's going on here is you got a paragraph. It's kind of hard to follow a paragraph, isn't it? But that's okay. Usually when you get information in the real world, it doesn't come in a nice, neat package. It's usually pretty sloppy and you get a lot more information than you need. So they started, so they had zero beginning inventory. So they started with zero. They started production on 101,000. So we got 101,000 units to account for. So that's step one of 4 steps. 1 down, 3 to go. All right, so I got 101,000 units to account for. It says 76,900 were assembled and transferred out. That's the key term, transferred out. All right, so there's my 76,900 transferred out. So that says then I must have 24,100 still in my inventory. Of course, you would want to do a physical inventory and go out there and count and make sure some of them weren't stolen, right? Or that somebody counted correctly and what was transferred out. All right, so units accounted for 101,000. But now we need to do the equivalent unit. You know, those individual exercises we just looked at. If it's transferred out, it's got to be the same all the way across. You can't transfer out a partial unit. Always remember that. And so the ending inventory says materials must be added at the beginning. Yep, right up there at the top. Direct materials are added at the beginning of the assembly process. So that 24,100 is going to be 24,100. But it says somewhere that 35%, there it is. Well, I can't highlight it in the info section. 35% of the way through the assembly process. So 35% of 24,100 is 8,435, 8,435. So I physically have 24,100 of these consoles, but from a theoretical standpoint, I really only have 8,435 from the standpoint of applying cost. All right, so we're done with the first half of this. Units to account for, units accounted for. And we'll use that again here in a minute when we allocate our cost per unit. All right, the second section is about cost to account for. We had zero beginning work in process. We added 375, 720 material, that's given. Our conversion costs were 157,500 plus 98,505. So that's what, 256,505. And so there's my total cost that we're given. All that's given. And so those are our costs to account for. All right, so now we're 3 ways through this 4-step process of the production cost report. All right, so now we want to divide that 375, 720 by what? Our units to account for, our units accounted for. So that gives me what? $3.72. And I did the same thing here for my conversion costs divided by my equivalent units up here, which is 85,335. That gives me $3. All right, so what do we do with that? Well, we're going to apply that to our units up here now, right? So $3 times 76.9, well, let's just jump down here and look. Completed and transferred out. $3 times 76.9, or excuse me, yeah, 76.9 gives me 230,700. And $3.72 times 76.9 gives me $286,068. So that tells me the journal entry I would make for transferring out my product. That's the journal entry we should make. Like right there it is in the T account. You actually don't have to make the journal entry. The journal entry that you would make once it's posted to the ledger is right there. And there it is. This is your general ledger, work in process. So that journal entry is missing, but that's how it goes from there to a journal entry to there posted to your ledger as inventory, your balance sheet. All right, and then the second part of this, the ending work in process, you're using that $3.72 times 24,100. I don't know if I can get all that on one page. Yeah, I can. $3.72 times 24,100 is 89,652. $3 times 84.35 gives me 25,305. And so that tells me what should be on my balance sheet for inventory and work in process. And there it is, 114,957. These numbers right here is a little confusing because in reality what that is the that is the 631,725. See, the 375,720. And then they break out this 256,005 into labor and overhead. But the total is 631,725. It's the total right here on this part that's being what? Accumulated. And of course, that overhead has been what? That's been applied. It's been allocated. Credit to manufacturing overhead. Debit to work in process. See how those journal entries fit together? All right, so that is chapter 18 for a second time today. And it's probably better the second time than the one I had for the first time. Hope you have a good weekend, and the next exam, chapter 16, 17, and 18. I think I had decentralized accounting, chapter 24, a small part, but I never did give any exercises there, so you don't have to worry about chapter 24 on the exam. Probably read that for your own self-improvement and edification on what goes on in a decentralized format in accounting and operations. But the next exam will be chapter 16, 17, and 18. All right, hope you have a good rest of the day. We'll talk again soon.